Yeah, maybe you could speak a little bit to that too while
Yeah,
people are coming in. So I think a lot of folks have not heard of BNY Mellon,
yeah,
uh,
yeah.
in spite of the historical relevance of the bank and the involvement in TARP and all the recent stuff that's happened.
Yeah, we could
Uh,
have another bailout on our hands, maybe.
yes. Yeah. So maybe you can kind of share a bit of kind of the story of BNY Mellon and a little bit about yourself, and then we can kind of dive into things as people get signed in.
Sure. Well, thanks so much for having me. It's nice to see Nick, and thanks Dan for including me here. Um, and so Bank of New York Mellon is casually known as BNY Mellon, and we were founded by Alexander Hamilton, one of the first banks in our country. We've been managing money for institutions and for families for over 2 centuries. So some of our clients are the same clients we had 235 years ago, which brings us to we're in a time of crisis in our country with pandemic, and our firm is heavily relied upon by regulatory agencies and by other banks and by other financial institutions for information and for stability. And so it's a really interesting time we're in. The good news is that banks are relatively stable right now. We're not seeing credit problems. We're not seeing cash problems. We are seeing some liquidity issues on the bond markets, but that's to be expected. So all the things we would expect to see during this health crisis are happening, but our bank is feeling really good about the stability of the U.S. financial system. So we're working with clients really heavily on a variety of issues, but right now we're the safe house. And so we're looking out to see if there's perhaps an airline bailout. We could be the custodian for those funds, for example, and did hold the TARP funds in 2008.
Right. Yeah. So as sort of a perspective on the magnitude of BNY Mellon, maybe this is a number that I've made up, but something like 1/4 of all global monetary transactions go through the bank. Did I make up that?
Yeah, so every day as dollars circulate the globe, it's one in every $4 hits our bank every single day. So we are a bank of banks for those. So we touch a lot of those transactions. We process transactions and then we custody assets at our bank. And then I work in the wealth management industry. So that's 12% of the big bank. And we're managing assets for wealthy families, institutions, and nonprofit entities.
Mm-hmm. Awesome. And maybe share a little bit of your story too, and then we can dig into kind of the bank's perspective on what's going on and answer anybody's questions. Feel free, folks who've jumped on, throw your questions in the chat or in the Q&A, and we'll direct them to Rachel.
Absolutely. So this has been an interesting year, 2020. I thought I talked maybe a little bit about the market and where we've been and where we are, and then a little bit about our clients and how we're working here in Seattle. So the market bottomed in March 9th of 2009. And when we've had this long equity recovery, a long bull market coming from there. And our clients have experienced a lot of growth in the stock market, a lot of opportunity in their businesses. A lot of our clients were business owners or still are business owners, and that's where a lot of their wealth was created. And so they've had a lot of flexibility over the past 11 years to build their balance sheets and really, really grow their businesses, but also their stock portfolios at the same time, and had really easy access to credit facilities and really working with people like you, Dan, to create efficiencies. And then here we are in 2020. I will tell you, not a lot of our clients have enjoyed the bull market. They've been waiting for something to happen for quite some time and been waiting for some catalyst thing to happen and stunt their plans. And here we are with the coronavirus. It is definitely the catalyst that has killed the bull market. And that's what equity markets do. And so they are killed off by very specific events. And we've had that happen about 3 weeks ago. Our institutional side of our business was thinking this was a shorter term correction for quite a while. And then now we're feeling like this is more of a recessionary event. But not all hope is lost. There's a lot of things that clients can be doing, and working with you, Dan, and all their advisors to help shore themselves up and get prepared and look for opportunity for what is to come in the next cycle. So like I say, a lot of our clients, I work in Seattle. We work with clients all over the Pacific Northwest. Most of them ran their own businesses or still do. And they're looking for opportunities to take advantage of dislocation right now. So like I say, the stock market is down 30% year to date in 2020. So what can we be doing now to prepare for what's to come? And so our clients are really focused on long-term objectives. So going back to the drawing board, what is the long-term objectives that they have? What do we need to work towards? And so Dan, when you use something like a roadmap, we do the same thing. So really crucial to keep going back to that roadmap and making sure we're marching towards whatever it is they want. Markets situations will be short-term. Really looking at balance sheets, and the Fed cut interest rates by 100 basis points over the weekend. So we're almost at zero interest rates. So what can you do in that situation? You can refinance debt. You can look for new opportunities to secure debt. So business owners looking at revolving lines of credit, looking at, will there be any hindrance in drawing from those lines of credit during a prolonged recession? Just really understanding what are the parameters there for cash flow. If you have mortgages on personal residences, taking a look at those now is a really great idea. Looking through any sort of debt facilities you might have and understanding if there's cash flow efficiencies that can be gained. This is the perfect time to do that. Clients that run businesses where you might have a taxable estate near the end of your life. So you might have more than $2 million in assets in Washington state or $20 million federally. This might be a good time to gift. Even if you have minor children, you can explore some gifting strategies of some of your company stock. You can start pushing assets that may be very, very valuable after a recovery, and in future cycles, you can start pushing some of these assets out of your estate now. And there's a lot of creative ways to do that, but this is the perfect window of opportunity. And then all the same things that clients should always be doing, they're just as important now. So calling your insurance person, making sure that you're really well covered for any insurance planning needs that you may have, making sure in your business that your employees are well covered. All the same things that people should be doing. Is your will signed? Is it in the file? All those things are really important. So we're working with clients on a lot of planning right now, knowing that things will improve and the stock market will come back and mergers and acquisitions will pick up to their normal pace. But this is a window of opportunity.
Right. Alistair had a question. What are you guys hearing or seeing about what the government or banking sector will be doing for hospitality, restaurants, hotels that will fail without some sort of support? Any idea of the mechanism?
Yeah, so far we've seen some of these bills floated, like just pushing money into the pocket of consumers. So like the $1,000 check for consumers. We're not that positive that that will create the catalyst we need here. We think more legislation is needed and hopefully coming shortly, like next week or the week after, to do some more legislative planning around protecting workers in the hospitality sector. But we think what we called it yesterday was a bazooka bill. We need the bazooka bill that will come out and protect some of these industries and really create consumer confidence. We do think that will happen, but I would give it a week or so.
A week or so? Great.
Yeah.
Alistair, let us know if you have a follow-up question or comment on that. Do you guys have any kind of position on what you see as a GDP contraction this year and when there'll be stabilization in the future? Do you guys have a position on that at this point that you're
GDP, our original growth expectation was not that exciting anyway. We were around 2% for the US and about 6% for China. So we were pretty muted anyway on our GDP expectations. Those will certainly be revised down. It's really important to note that the stock market is a leading indicator and then the economy follows. So what we're going to see, hopefully, is the stock market will bounce off the bottom and have a V-shaped recovery. And then the economy will have terrible numbers. And I quote terrible from our chief economist as of yesterday. And that will continue for a couple of quarters or more. So GDP, I would think 1.51, really, really muted economic growth this year.
Okay. I know in our, hopefully okay to reference our private text messages, but I know one of the things you mentioned was clients being eager to into the market. So I don't think I'm overstepping by mentioning that.
No. This could be one of the most exciting entry points for equity investors of the generation. We have many clients that maybe exited their businesses or had a liquidity event in the past 10 years. And like I say, did not love the bull market. It wasn't that exciting. It was designed to be this long and slow bull market. And so clients held on to cash for a really, really long time. A lot of wealthy people sitting on large cash positions, and all of a sudden valuations are incredible. With a 2 or 3 week dive in the stock market, it's an incredible opportunity to purchase really high quality companies. So we've already started to see some resilience in the tech sector. Biotech, some of these really innovative companies are showing a lot of resilience. So the challenging thing with clients in this position is, how do you nibble away and toss some cash into the equity markets without throwing everything in and taking on too much risk too early? So we're encouraging a little bit of prudence and patience. We've not called to rebalance yet, meaning we have not called to sell bonds and buy stocks yet. It'll still be a couple more weeks, but that call will come, and then it will be time to invest in equities again. Mm-hmm. But it could be a huge opportunity, a great entry point.
Yeah, maybe you can sort of explain a little bit what you mean by rebalance, and then if you can speak to what you think is the trigger point for when folks should take action on that.
Yeah, so most of our client portfolios, they have an element of stocks, and then they have an element of bonds or alternative investments. So most of them are diversified. We don't have too many clients that invest 100% in stocks. And so what we have is, when the stock market falls, all of a sudden a portfolio that used to have 70% in stocks has 50% in stocks. All of a sudden they're valued much less. And it looks like the portfolio should sell safer assets and buy stocks to rebalance back to that original 70% objective. And so we are not encouraging participating in a major rebalance at this point, selling cash and bonds and buying stocks quite yet. That time will come. So being patient about that and looking for a good equity entry point. And I think it will have to do with legislation. It will have to do with a broad-based legislation passing and giving the stock market more confidence.
Mm-hmm. Great. Alistair had a follow-up question on if you had any idea of the mechanism that might be utilized to prop up those small businesses. What are you hearing? Loss of business insurance policies being ordered, even though they are all avoided by the virus, bacteria, payroll tax, moratorium. He says, I think bailing out small business is much harder to find an effective mechanism to facilitate that, whereas a big corporation is easier.
We would agree. It's going to be more difficult because, like I say, I've seen these plans floated so far that are like send $1,000 checks to consumers and trying to fuel the consumer's pocketbook and push that money back into the economy. But that's really challenging. What if they save it? What if they don't spend it? And then also, and then you're right, on the insurance side, holding these larger corporations accountable for helping small businesses and maintaining their commitment. I think that's going to be a big part of broad-based legislation here. But we haven't seen any any foundational plans yet. And I hope that will come soon to help small businesses in particular, because that will be a huge part of this recovery. During the initial market correction, we were seeing a supply chain hit, and it was this really, really broad-based hit on the supply chain. But now we're immediately seeing the demand pull back. And so now we're seeing like some of these characteristics of a broader recession come into play. And so you're right, Alistair, a big piece will be fueling small businesses from the ground up. What are the bottom up ways that governments can do that?
Great. Any perspective that you guys have or you have on alternative investments at this point?
Yeah, so BNY Mellon, we use all methods of investments, derivatives, alternative investments. We own many firms that also manage those assets. We're seeing a lot of interest still in the real estate type investments, whether they be commingled funds or some of the hedge funds that have real estate exposure. I think a lot of Pacific Northwest clients looking for exposure in markets that are maybe more, that are better priced. And so looking for, are there markets in the Midwest or the South? And so looking for some more commingled funds to complement local real estate exposure. A lot of the business owners that we work with, they may own the property that they're working with in the Pacific Northwest, and they've seen a great appreciation there and a lot of opportunity to rent that property in the long term, even if perhaps they're not working in the business anymore. However, looking for opportunities to diversify, really popular right now. Some of the alternative investments are liquid. Being really careful about liquid alternative investments. What do they cost? So you can find, if anybody has any questions about that, come back to Dan about specific alternatives, but being sure that they're efficient and that they don't cost you too much. Sometimes they cost more than they're worth in terms of liquidity and diversification. One investment class that we use in our portfolio is called managed futures. It's a broad bucket of all kinds of things, metals and commodities and currencies, but it has a little bit of a derivative component. It loves volatility, and we've kept it in there through the whole bull market. It's sat dormant. It's not done a lot during these rapidly rising bull markets, but it is up the past 3 weeks, you know, and so it has its time. And so managed futures is something that's maybe something you can get efficiently in a portfolio through a mutual fund that does cause, that's not correlated to a stock or a bond market. We do have some commodities exposure. We would consider that an alternative. Be very, very careful with commodities. Even in these past couple of weeks, gold has gone down. You know, some of the survivalist type clients, they love to have the gold at the house and it's really special to them, but be very, very careful about exposure there. If you have an actual physical metal, it's hard to protect. You can't insure it. If you have it in your portfolio, it can be really volatile. So be very careful about not large exposures to commodities. And then all the traditional hedge funds are certainly out there. Long and short hedge funds that take advantage of short selling stocks or taking advantage of when stocks go down, they will certainly mitigate some of the volatility in portfolios, but they're not as exciting as equities. So what we see with clients is that they find them less than thrilling. They cost a lot, they're expensive to manage. And so typically we see that a lot on the institutional side of the business in the nonprofit sector. But a lot of individual families, they don't get that excited about the returns. They would maybe rather invest in publicly traded stocks at the end of the day and stomach a little bit of additional volatility. Yeah. So any more questions about that, just let me know. But that's some of the things that we've kind of seen materialize here.
Great. Yeah, thanks for that. You know, in the past, and I say past like 2 weeks ago,
yeah,
2 weeks ago, for a lot of our mutual clients who were kind of really just entering into the market, I would describe our collective approach as sort of a soft entry, where kind of slowly ease them in to into the market, right, with a mixture of cash equivalent type accounts, they get them a little bit higher yield than they were getting from traditional banks, right? And then easing them into the market so much to get them comfortable with it. For those who have some money on the sidelines currently, who have maybe a appropriate reserve account, and they want to take advantage of some compression in value, how are you recommending people enter the market at this point?
Yeah, so we call it nibbling. So we are putting money into the equity markets, but just like you say, Dan, we're tiptoeing in. It's really hard, especially if you've owned and operated your own business for your whole career, and then you have some cash. To put it into other people's businesses is probably the hardest thing you'll ever do, and to have faith in a stock market. And so the first generation business owner, it's carving off sections of that money and diversifying it broadly across a variety of markets, and understanding that in the long term, when we look back on this event 10 years from now, this will be a phenomenal entry point. But today, it might be a little rough. And today, you might lose money on those initial investments. And so it has to be, the sleep at night factor has to be achieved. You have to be able to sleep at night and stomach that volatility, or else the allocation is not the allocation for you. So we're working really hard with clients right now with the cash positions to ease them in. We are opening CDs, money market funds, as kind of the safe house and the place to hold that cash until that client might be ready and comfortable, or it might be an appropriate entry point for them. Like I say, we look back on this 10 years from now, we'll say we're the smartest people ever for investing in the stock market, but it might not feel that way for another 3 or 4 months until we see that recovery start to happen.
Okay. Alistair had another question around, what are your thoughts on a potential pullback on commercial real estate prices due to the proliferation of working from home and the fact that this event has provided widespread adoption of that?
Yeah, so it's interesting. We kind of talk about the Pacific Northwest real estate market, and then we talk about the rest of the real estate market. We don't believe that the Northern California, Washington, Oregon commercial real estate market will have a significant correction, but definitely a small correction. I've seen some notes this morning from business owners about fear, about rents not being paid on time, about delays, and we're going to have that during a recessionary period. And if the federal government is starting to say, we can delay paying our taxes, we can pass legislation for rents to be delayed and no eviction, that sort of thing, then we're going to see a slowdown in commercial real estate. However, what I will tell you is there's lots of eager buyers also on the sidelines waiting for that deal and waiting for the excitement of picking up a property, especially in the Pacific Northwest, at maybe a small value, maybe not even a large value. So we have many family office clients in our Seattle office that have been waiting for this moment, for just any opportunity to kind of negotiate a price down a little bit. But I don't think it's going to be significant in our market.
Great. I guess we got about 6 minutes left. Any other tips or things that come to mind that you're sharing with your clients, or ways that it sounds like most of your clients are pretty opportunistic right now, but any that you need to rest assured?
Yeah, I think with clients, it's really turning to their advisors at this time, and it can be extremely emotional. So even if I call a client and they pretend like this is just another correction, I've been through 2008, I've invested through this before, my kids will do this 10 more times in their lifetime, it can still be extremely emotional. So just being patient, I think, is one of the more difficult things, and really listening to the advisors. And I've had a lot of client calls where we've gotten off the phone and they've said, I talk to you all the time, but I'm glad we have this discussion. So I just encourage people to call Dan, call your estate planning attorney, call your advisors at this time, because it can be really calming to get that global view and step back a little bit from the short term. There's a lot of bad news, and we need to kind of step back and look at this in a longer term global sense. And then really focusing on the long-term objectives. This could be a tremendous opportunity and dislocation in the markets that we could not see for a very long time. So being really focused about what you're trying to achieve, and really working on taking those baby steps towards your goals.
Great. See if Nick, any questions you have on your end? Anybody else in the group? Any questions? Drop them in before Rachel drops off.
We got Alistair's on fire today. He asked any thoughts on the timeline of quarantine / shelter in place. Where do you see significant additional pitfalls at 90 days, 120 days? What length leads to significant larger economic challenges?
Yeah, it's a really good question. So this is fascinating for us. So we, in our Seattle.
Just lost you, Rachel.
All right. There we go.
Sorry, my phone took over for a minute. We were one of the first offices in the Seattle market that really got on board with this quarantine thing. And we did a lot of work with our firm in general, warning them in New York that this is happening, this is coming. And they quickly got on board, and we've been quarantined and working with our clients in this way, but quickly understanding that the economic impacts will occur. And so we're at a point now in Washington State where our kids won't be back in school till April 24th. We see the same in Northern California, in New York. So these are big markets where people need to be at work. So we're not going to have a slowdown of some of the industries that can work remotely, but certainly we're going to have a change in the way everybody works, and some of the small businesses will be impacted. So that's when our prediction changed to more of a recessionary outlook. So that's when the statistics of recession went from 10% up to like 45%. So we believe we are in a recession now. And the economic data, as I said before, we quoted terrible for the next few quarters. It's going to be like a 2 to 3 quarter event. We think in 18 months that we can recover from this.
Awesome. Great. I think that I really appreciate you coming on. And
thank you.
Send me questions. I can get them in front of Rachel and her team. One of the nice things about my partnership with BNY Mellon is that I get access to people like Rachel and kind of the whole team there, which is global. So appreciate you, Rachel, and stay healthy. Say hi to the family for me.
Yeah, no, we're all up to speed. So any questions, we're all engaged at work. So just funnel them our way. We're here to help.
Awesome. Cool. Well, I'm going to stay on for a moment. Rachel, thanks again.
Thanks so much, guys.
Drop off, and just wanted to share with everyone. Many of you have probably already heard, but the deadline for filing your tax return has been officially pushed out to July 15th. So when we last spoke on this topic, there was a 90-day extension for paying any tax due. So 90-day extension from April 15th for paying any tax due, but you still had to file your return on April 15th, or you had to file an extension. So now you would not have to file an extension until July 15th. So basically the filing date has been moved out from April 15th to July 15th. The Q1 2020 payment for any tax due also usually due April 15th, which can be a double whammy for folks where they have to pay both their prior year final tax payment and the first quarter estimated tax due. Of course, I generally recommend that we automate those payments, but if you're making quarterly payments, that's also been pushed out 90 days, that Q1 payment. So a couple of updates there. I'm still strongly urging folks, let's get certainty around your return. And if you have a refund, let's get that refund process. Right now, there aren't any delays that we've seen on processing the refunds. And otherwise, get the return finalized so you know the balance due, so you can plan your cash flow accordingly. And then either you can just file the return and not pay it for 90 days, or you can wait and file it. Either way, at this point, it's kind of a moot point on whether you file or whether you wait. I'm one who just likes to have things done and off my plate. So that's my bias towards just getting it filed in general. But again, I think you want to bias towards certainty around your cash flow in this uncertain time. So I wanted to share that. On Monday's call, we'll have Randy Massingale on. Randy's been my personal mentor for several years. And when I met him, it was a period of inflection in my business where I felt like I kept making the same mistakes. And somewhat at my wife's urging said, I think you need to hire a coach. And so I reached out to some friends, and a couple people texted back, you got to talk to Randy. I can't describe him to you because he's completely unconventional. And so you're just going to have to meet him. And of course, I fancy myself to be non-conventional. So that's all I needed to hear. And sure enough, he is every bit unconventional. You can hear him in episode 2 of my podcast, Reading the Game, as well, to get a sense. But Randy's had a pretty eclectic career, from working with Bill Gates in the early days, Microsoft, Intel, InfoSpace. Now he is a professor at Seattle U in executive leadership and running closely held businesses. And he's just got a really unique perspective on how to play your game, and especially how to play your game in uncertain times. And I've leaned on him heavily in a few inflection points in my life in uncertain times. Of course, this one is a more extreme one, but honored that he accepted the invitation to come on. And so it's going to be a little bit different style than the 5 calls that we've had up to this point that have been more focused specifically on finance. But I think it's appropriate to bring on someone like Randy to share his viewpoint on continuing to try to play your game, whatever that may be, through these uncertain times. So I wanted to share that. And I know Nick's met Randy before, so he can share his perspective as well. But I think you're going to find that one to be maybe the most interesting and most impactful of the ones we've done thus far. Nick, anything you want to add?
I just dropped the podcast episode in the group. No, I mean, you said, I actually was fortunate to spend a whole day and a half with Randy because we did we went out on a boat and all that stuff. When you talk about, I always talk about wisdom in decision making. You cannot, after you meet Randy, you cannot think or hear the word just wisdom without immediately thinking of Randy, the way he carries himself, and just, he's one of those guys that he just says like a one-liner and everything makes sense all of a sudden.
Yeah.
Exactly the kind of person that I would try to surround myself with. I've actually been trying to get to Seattle before everything got shut down to do that. In times like this, because he has, frankly, he has the thing that I don't have, that a lot of people may or may not have on this call. But it's water under the bridge. Just the amount of experience that he has accumulated is one of those things that, you have to value, because you can't manufacture it. You just have to time. You just got to have the time, and he has a lot of that. So I'm super happy that I was on that text thread when you invited him and he accepted.
Yeah. Cool. All right. Reach out to me if you have questions, if I can be of assistance. I know the same from Nick, and hope we'll see you all on Monday.
We'll see you Monday.